Well, I'm excited to welcome to the show, Mr. Sam Morris. How are we doing today?
Excellent, Matt. Glad to talk to you.
Love it. Well, I know there's a lot going on in the multifamily world right now. There has been really post-COVID, so I know we're going to unpack a lot of kind of what you guys have been up to. For those that have never heard of you before, how would you describe what you do and who you are in a few short sentences?
Yeah, so I'm partner at LSC Real. We are effectively owner-operators in the great state of Texas. We own a little less than 6,000 units here, and we are a fully vertically integrated company. So we do property management, asset management, construction management, accounting, all in-house. And we're kind of that one-stop shop for those investors that invest alongside of us into our deals.
Love it. Now, you've been involved in over 800 million in real estate deals, which is, no small feat. So you've seen and touched, I'm sure, a lot of different assets with various strategies kind of deployed with various capital stacks deployed. So maybe you can share real fast before we maybe rewind a little bit and talk about how we got to where you're at today. What type of deals are you guys focusing on today right now in the current landscape?
Yeah, we're kind of hyper vigilant on location. That's a big deal for us. But our buy box is, call it in that $30 to $70 million range. We're looking for, what I would say a larger, more well-located apartment complex. And because of that size alone, it's going to push us more into the primary markets here in Texas. So we buy in what we call the Texas Triangle. So think Houston, think Dallas. Those are probably our two primary markets. About 80% of our units are in Houston. And so we always have an eye on Dallas, San Antonio, and Austin's kind of in carnage. But, we know our state really well, and we invest where we know.
Now, obviously, post-COVID, crazy boom, multifamily was by far, I think, probably the biggest or one of the biggest beneficiaries of that boom. But then also, obviously, interest rates rising, a lot of headwinds with, what's been going on in the, kind of rental market. And I'm curious, in light of all of the challenges and the headwinds, and we'll unpack a lot of that, like what about the multifamily market excites you most right now?
Yeah, so you say interest rates and things like that. We definitely had a run up to with COVID because occupancies really filled up. But
Yep.
interest rates really were secondary, in my opinion, to really the bigger issue, which was supply. Because as soon as occupancies went through the roof, people started building like crazy, and we really overbuilt. And well, I wouldn't even say necessarily overbuilt, but we built so much in such a short period of time. It takes a while for all of that for all that vacancy to get occupied. And so, the oversupply was really what kind of made us, dip down more so even than the interest rates going up. Although that absolutely hurt a lot of operators out there that were dealing with floating rate debt. Uh, but the supply really was the bigger issue. And what we've seen really, and particularly in Texas and more so in Houston and Dallas, which are really very high growth, high populated areas where a lot of the growth of the country is coming, you're seeing a lot of that excess supply being chewed through at a more rapid pace. And when you start to see that, and there's a lack of supply coming on with it, it gets you excited because from a cycle perspective that the next thing is kind of organic rent growth and more values that are going to be created from it. And so that's really something that gets us excited right now. And that's really more local focused too, which real estate is local. There's no doubt about it. And so with where we are and where we're experts in, we're excited about the markets that we're in. If you look at more from a macro or a national picture, I really wouldn't be able to speak too much into it, but there are definitely markets that were oversaturated with supply and are having harder times getting through that. And then there were markets that didn't have as much supply, and they've actually, a lot of those have recovered, and you're seeing rent growth. And, in certain areas in California where you're at, you're already seeing rent growth again.
Yeah.
In certain areas, say in the Northeast, you're already seeing rent growth there again. And it's because they didn't have the oversupply that a lot of us did in the Sun Belt and some of the other areas. And so now that we're seeing some of that get chewed through, it kind of gets us exciting again because, there's a natural progression towards as occupancies rise, rents will grow with it. And, that leads to better investments for us and for our investors.
Yeah, 100%. I saw recently too, I think I saw that it was renewals were jumping at a really healthy clip. Obviously, I think, higher interest rates and affordability for people that are your tenants going, I don't necessarily know if I can afford or want to move right now. Let's just renew. Obviously that helps kind of with absorption and occupancy and stabilizing, values and revenue.
Very
Um,
much so.
you guys are, I'm sure, seeing a lot of that in your neck of the woods. Where you spoke to cycles, right? And obviously every real estate market, every stock market, just our economy in general, it goes through cycles. Like, how would you assess maybe the last handful of years in terms of the real estate cycle for your asset class? Obviously, you guys are very market specific. What is that perspective for you?
It's funny you say that because I remember talking to the guys last year, and I first started investing in larger multifamily in 2007.
Okay.
So, that's more than a minute ago at this point, right? And so when we were doing those bigger projects, we had 2008 and 2009 occur, and we tell people that's like it kind of felt like you were, given a knife and told to go into the gunfight because you had to learn how to operate people around you.
Yep.
But we were acquiring through that time frame too. And I remember buying a deal in 2010, and it was kind of scary at the time, and we were really wanting to be cautious in the way we were doing things. And last year, so in 2025, and kind of earlier in the year, I remember telling the guys going, "Hey, this kind of feels like 2010 again." And what I meant by that was it was, we didn't have all the answers. Things
Right.
weren't, just easy to do the way it was just a few years ago. But I do remember by 2012, 2013, we were sitting there looking back going, why didn't we buy everything in 2010? I mean, that was perfect time to be buying as much as you can. People were scared. There weren't as many buyers, and you can get things at prices that made a lot of sense, but it was still kind of a scarier time to operate. And so last year, that's what I was telling the guys. I said, it kind of feels like 2010. I don't have numbers to back it up, but it kind of feels like it was 15 years ago. And so it looks like it's kind of proving out that way. The it wasn't just kind of a V-shaped recovery for real estate. We're still kind of in that U-shaped recovery. And so you can kind of start to see where the signs of, hey, this is improving, or these metrics are improving, or these KPIs are improving. And we've been seeing that now for probably the last 18 months on a lot of things. And there's still some more things you'd want to see, but it kind of feels like that time 15 years ago at this point. And so obviously you have to have some gray hairs to probably even remember that time frame. But there's guys in our company that they were not they were not in the industry at that time frame. Probably the
Yeah.
easiest way to say it.
Yeah. I cut my teeth in real estate in 2010, and I didn't know anything. I was just getting out of college. I didn't know anything different. So I kind of look back and am grateful that I came in those challenging times, because when it got
Sure.
a lot easier and more plentiful, I was like, oh, this is what a good market feels like, right? And I try and remind people of that too, that are just getting in the game, that are right now going, man, this is a challenging market. And yeah, if you can make it in this market, you can make
You're
it
going
when
to
the
do really
market's going to
well.
turn. And again, you just kind of have to keep your head on straight and the right perspective, that this is a long-term game, and it's going to have ebbs and flows and peaks and valleys. And you kind of got to, learn how to navigate all of them if you want to be successful and have longevity in this. But it's really the investors who have the most stamina, can weather the storms, and ultimately just not, get crushed like we've seen, unfortunately, a lot of people in previous crashes, and even, post COVID, a lot of the rosy blue sky scenarios of rents are never going to plateau and cap rates are going to stay compressed, and no way will we see 7% interest rates. That sounds nuts. Obviously those modeling assumptions are really critical for making sure that not only you can thrive, but most importantly, that you can just protect and build a moat around what you've, accumulated thus far. So I want to maybe back up a little bit and talk about your previous life, You spent 18 years in corporate banking before you decided to kind of, take that transition and plunge into, real estate and the ownership side. What was it that made you decide to jump into real estate?
Yeah. So I was I was fortunate at a time where we had sold our bank, and so I had the ability where I had a liquidity event and was able to go. You know what is my next step? And I'd already been involved in about $1 billion worth of transactions on the lending side. And so kind of had a great knowledge, and I was already investing alongside of guys and things like that. And so I had a pretty good understanding of how to operate and what was going on really from the quantitative side. And so I understood a lot. And that's why I tell people, I mean, my first few years in banking, going back, you know, over a quarter century ago now at this point, but uh, all I did all day, every day was underwrite deals. And so when all you do all day, every day is underwriting, um, you begin to have a pretty good understanding of what numbers look like, how things should trend, and things of that nature. And I got my master class. I mean, if they tell you it takes 10,000 hours to be a master at something, I mean, I was a master underwriter probably before I was 25 years old. And so I had a great understanding of numbers, knew what to look for, could spot trends. And so that was very helpful. And I wasn't necessarily doing that to become, a real estate person. I was really doing that because that was my training from a banking standpoint. And, you know, the bank in this world, or a lender in this world, for the most part, in most real estate transactions, that's the biggest partner in the deal,
Yeah.
because most people typically borrow more than 50% to go acquire a deal. Most people do. I mean,
Yeah.
I would say the majority of transactions. And so your lender is going to be your biggest partner in the deal. And understanding how to communicate with the lender, because they have their own language too, right? Just like in real estate, we have our own language, right? We have our own acronyms, we have our own way of saying things. In the lending world, they do too, right? And so being able to communicate that way, very helpful. Being able to understand what their thought process is, being the biggest, investor in your deal, is very helpful. Knowing how to express and articulate what your needs and desires are for a deal, it's very helpful. And so, and if you get into a challenge with certain things too, knowing what you need to say, how you need to say it, and when you need to say it is important and helpful. And so, getting that education early on, and having that understanding, and more so from the underwriting side and understanding the quantitative side of things, it really was beneficial to go, all right, I'm ready to jump into this, and I have a great understanding of what needs to be done from this side of the real estate world. And so, yeah, it was a great education, no doubt, and it's not something I don't think you can replicate in the real estate world. You literally have to be in that world. And so to make the jump, it was one of those things where it was a time in my life where, hey, I'm ready to go. This I'm ready to do full time, and I can't wait to get involved on that side of the business and learn all these aspects and grow from there.
Yeah, I mean, having that skill set, I always share with people, if there was one skill set that I would encourage you not to delegate and to try and master yourself, it's financial modeling, it's underwriting, it's really understanding the levers and economics of a deal and how all of those pieces come together. Because that, engineering a capital stack and understanding how all the puzzle pieces fit together, and obviously it's a big way of how you mitigate risk, but it's also a big way of how you arbitrage upside and
Mhm.
understand where the real alpha in a lot of deals are at. And if you can't understand, it's one thing to be an operator and, to execute on the X's and O's and the tackling and blocking. Um, but if you don't start with a great, capital stack and plan and really make your money on the buy, and you realize it over time as you operate it, um, that's a major disadvantage, or it's a major advantage like you had coming into the space. I always used to tell people, I'm not a numbers guy. I'm not a numbers guy. I'm the relationship guy, and over time I had to really like shift my mindset and identity of going, I got to master this. And it's been extremely valuable in terms of how it's helped me, put deals together and to be able to speak both sides of that fence, right? Of like, hey, I got to put my finance hat on right now versus, oh, I got to put my biz dev hat on, my schmoozing hat on. It's,
Mhm.
two different skill sets, but when you can speak both sides of that fence, it makes you a little bit more weaponized and dangerous.
For sure, for sure. And one of the things I tell people is, I did this so much for so long that at this point, I read numbers the way you read words.
Mm,
So my whole career in banking, you're reading things to try to figure out, all right, well, what's going on here? And so a lot of times you could sit there and go, all right, there's an issue here. And I could see it from a quantitative perspective, but I maybe don't know what it is from a qualitative perspective. And that's where marrying, you can marry the qualitative side together and go, now I have the whole picture because I'm on both sides of it and I can actually figure out exactly what this is. But when you can read a financial statement and go, you have a problem here in X, Y, and Z, I may know that there's a challenge there. I may not know exactly why, but I can point out, hey,
yep.
you know, if your water bill's going crazy these last 2 months and it hadn't been doing that the previous 12, you might have a leak somewhere. I don't know where, but you might have a leak somewhere, right?
Right.
Only to find out, oh yeah, we had a busted pipe on building 8. Okay, well, it shows in the numbers, and here's how that impacted you.
Yep. 100%. Now, we'll take this back to maybe those early days of Sunset Capital when you decided, all right, I'm leaving banking. I know we have a lot of people that listen to the show that are either high income earners and are very interested in either investing alongside as an LP with another, seasoned investor, or they may be looking to, take the plunge themselves
Yeah.
and jump in, right? And, here in the $800 million of multifamily real estate assets, right, we kind of see, where you're at today. How did those first few deals look like? How did you, kind of take your licks? And obviously, I was called my
you
failing
have to,
forward
right? I mean,
moments.
you're gonna learn things. There's gonna be things that you're growing from, right? And I got battle scars just like anybody else, and so. But I mean, I would even go back further too when when the very first deal that I was ever a part of in 2007. It was either 07 or 08 when we bought that one, and we bought it. We closed in August. It was 100% leased here in Houston, Texas. And the very next month, we had a major hurricane come through and destroy the property.
Oh,
And when I say destroy the property, I mean, we went from 100% leased to 12% leased overnight, right? And quickly you learned what insurance was all about. And you had to get yourself a quick education on all of the aspects that are entailed there. And fortunately, I already knew, because of the banking side, I already knew draw processes. I already knew how to deal with insurance companies from our side. But when you're dealing with them on the real estate side, it's very different, right? Quickly, you learn that legally in the state of Texas, when you sign a lease with the landlord, you're obligated to provide them housing. So these people whose home is destroyed, right? I had to find a way to find them alternative housing, right? Because that's what I was on the hook for. I mean, we had a contract that I would provide you housing, right? And so there's a lot of things that you learn going through big events like that, an act of God, which helped me learn a lot of things, right? But I quickly learned on the positive side to it, if you had good relationships with contractors, and we already did, right? We already knew some of the things we were going to do. Our scope of work changed from when we acquired the property, obviously, because the buildings were destroyed. But when we were done, we had something that was far greater than what we thought we were going to originally do with our original business plan. And, we were able to bring the bulk of those residents back. And guess what? Because they had new appliances and new flooring and new everything in their unit, they were ready to pay even more to live there because we provided them something much greater than what they had. And all of a sudden, the value of that property goes up. And I really learned at that point how we actually value property. Right. I learned real hardcore what NOI and cap rate and those two correlations, what that does to value. And then I learned, man, we can actually go leverage this up and provide more equity to the investors, and we can be in this thing without having any dollars. I mean, this is incredible. And so that first deal really got me hooked because we were able to return dollars back in a short order, granted via an act of God, back to our investor base where everybody was out whole and they still own the property. And so, something amazing like that was, wow, now I can really see how building the value of these things can really make a difference and how you can actually get a multiple on your money. And so it was an eye-opening experience as an investor into that deal and going, okay, now I understand, I've lived this now and I've
Yeah.
gone through it and I can actually build something on this. And so it was really from that I go, all right, I'm hooked and I'm ready to do more of these on an ongoing basis. And so I don't know how many deals we've done in my lifetime, but it's been more than a few dozen at this point. And I'm excited to continue to grow this way because you know from a passion, you can tell I'm passionate about this stuff, but I love the fact, like at LSCRE, we have 5,988 units. So we service almost 6,000 families that we provide housing for. And we have the opportunity to make their experience for their homes a great one. And, I love that. It's a great passion to be able to get up every day and go, yeah, I'm helping provide housing for almost 6,000 families. And, I can make their experience a great one living with us.
Yeah, absolutely. Now, when you look at multifamily deals today, what are some of the first things that you look at that help you kind of determine this is, passes the sniff test. We like this. Let's maybe take this to a deeper stage of underwriting.
Sure. Yeah. I mean, number one is location. So if it's in a bad area, it's not a go for us. But if you're looking at it and it passes that, I'm looking at the schools, I'm looking at crime around it. I'm actually looking at a lot of qualitative things, not necessarily quantitative yet. So it's got to pass the test of this is a great area to be in. Like there's going to be desirability to live here, right? And it's not necessarily, I would say, the quality of the asset either, because we'll go buy a C class asset that's in an A class area. I won't go buy an A class asset that's in a C class area. And so location is still a primary driver for that. But around those things, right? If you have good schools, you have low crime, great jobs that are around it, and you have a population that's growing and it's in a good location, that passes the sniff test for us to go, all right, let's go start underwriting it and see where the numbers are from this.
And once you kind of take it to stage two, what are, some of the core metrics of a winning deal for you guys? Or what, would you say separates maybe a good multifamily deal from like the great ones that you guys are looking for?
Yeah. And so, like with our last, I would say for like some of the last deals, like we closed the deal actually this month, a few weeks ago. We bought it from a larger institution that we've traded with now 4 times or so in the last 20 months.
Oh,
And this
wow.
is a pretty big group. So they have a lot of units. Um, but one of the things and it's a brother property to a sister property that we already own. So one of the things we were looking at, so we already liked the area, already liked, we had already had everything from a top line probably underwritten on this deal. Like this is something we're going to be willing to look at. But one of the things we already knew too is how that operator operated, right? From a cost perspective, what type of, meat was on the bone, so to speak,
Right.
from the get-go. And so we knew we can come in there and we knew from a top line, they had kept it pretty close to where market was. They were a big operator. They knew what to do. They knew they had dynamic pricing. So their pricing model was kind of where it was at market. We knew we weren't going to attack much from a top line. But what we knew we could do is drastically reduce costs without reducing any amenities or anything, expectations of the resident base. But there was also a few things that we'd already done at the sister property that we knew we could do at the brother property and that residents wanted and would be willing to pay for. And that's without touching rent. And so there was some excitement there because we knew how we could effectively operate differently in a more efficient manner than the existing, operators that were there. And so it's every property is going to be a little different.
Right.
But like I said, from us, if it passes that location, where we have all the good things from a qualitative perspective around it, there are a lot of things that we can do. Go, all right, now let's look at the market. Tell me where you are compared to the submarket and what's being offered here that we would normally offer, or what's being done here that we can actually improve upon. And that's really where you start digging in to go to that next level.
And what kind of deal metric targets do you guys aim for at a bare minimum when you guys are looking to buy an asset?
To our investor base,
Yeah, yeah, or maybe even just on a deal level.
I would say net to the investor, because that's actually how we like to look at a lot of things, is net to the investor, to the LP.
Yep.
I mean, I would say we try to target that 15 IRR. And so we're pushing close to to 2xing the money sometime in that first 5 years. And so, and along that way, we would try to say cash flow between that you'll call it 4.5 to 6.5 range. And so providing a great asset, great location, and getting those kind of risk adjusted returns, that normally hits a lot of check boxes for a lot of our investor base.
Yeah, makes sense. Now, what do you guys do in terms of kind of risk mitigation? I always love kind of hearing how everybody views through the risk
Sure.
lens. How do you guys
Absolutely.
view it? How do you guys mitigate it for your deals, your investors?
For
What does that look
sure.
like?
Look, ex-banker talking here, right? So I'm big on that,
Yeah.
right? And you heard me just say risk-adjusted returns. So I'm not looking to go 10x of money on a deal. I know there are a lot of operators out there who say, yeah, we're going to go just crush it, hit this massive home run on this thing. I'm I'm more, let's get it down the fairway. And
Yeah.
I have capital preservation first in mind, and then returns and everything. I want to know the dollars we're putting in are secure and safe. And so part of the way we do that too is the way we finance it, the way we'll take on debt, right? And so our underwriting base is 65% leverage.
Okay.
So to get to those kinds of returns and doing 65% leverage, you also
Yeah.
know that means
Solid deals.
we're churning a lot of deals. They have to be the right deal. We have to be buying them right. But because we're taking on 65% leverage too, even in this world, agency deals, things of that nature, I like to own it with interest only for the life of the deal. So if we're going out and getting a 5-year deal, I want it to be interest only for 5 years. And that does a few things for me. And part of to get that, you have to have the leverage be a little bit lower than what I would say most market guys would do. Um, but it gives me consistency. I know what the debt is each and every month. I know where we're going to have to be each and every month. And so when you operate, right, it's not just a steady this when you're operating apartments. You're going up and down, up and down, up and down. I mean, we could be 92% this month and then 96% the next month. And so there's going to be little ups and down swings each and every month. And you're tweaking the operations each and every month in the deal. And so as much as I can keep consistent, right, it takes that much more risk off the deal for me being able to go, yeah, I'm fairly certain I can go ahead and give you 6% cash flow each and every month for the next 12 months on this deal, right? Because I have consistency on a lot of the expenses that I have. And so when you're talking about that risk mitigation, things like that, right? I mean, making sure insurance is properly done at the front end, making sure you have all your third-party reports in the front end. But a lot of it has to do with the way that we structure the debt, because that's going to be a risk mitigator for investors on an ongoing basis.
Couldn't agree more. Now, raising capital. Obviously, I know you've got a lot of different investor partners in the, LP capacity of your deals. What has been your guys' approach for raising capital, finding the right suitability for your deals and your investors? How do you guys approach that?
Yeah, so we're pretty simple. So we use retail dollars. And so we're about 50-50 between our LPs, our internal LPs, and using fund managers. So we'll utilize fund managers out there who have typically retail dollars as well, and then our own retail dollars. The only really different caveat for us is that we'll use 1031 money too. So
Okay.
we're a big believer in 1031 dollars.
Love it.
Uh, Yeah, and so we actually closed the deal. I'm actually going there right after this meeting, and back in October, where we had a 1031, a reverse 1031, and a 1033 exchange all into that single deal.
Oh,
And
dang.
so our director of investor relations, Dasha Beardsley, literally wrote the book on how to use syndication dollars into multifamily real estate. And so with your 1031, so she absolutely is one of the experts in the country. And the last deal we actually just closed, we had 1031 dollars in it as well. So, I mean, I would say any conventional deal we do, we're going to have probably 1031 money in it as well.
Okay. Yeah. I mean, I know a lot of people either don't allow 1031 capital into their syndications, or they don't believe in 1031s and they think you should just pay the taxes. Obviously you guys are very pro 1031, as am I. I've done a lot of 1031s myself in my own deals. But obviously there's things that you need to be aware of and ensure
Yeah.
kind of align with the strategy and the capital. How do you guys look at that? Like what has led you to taking that stance in the
Yeah.
1031 world?
One, because I mean, we really want to be, and our fund managers love it too, because you can raise dollars one time for one deal. And our hope is that we're going to be able to keep rolling that into the next deal. And so you
Right.
raise money. Let's just say I'm a fund manager and I raised $1 million to put into your deal. Well, that $1 million could be, let's just say it's $1.7 million when we sell it later on, and you can roll that $1.7 million into the next deal, and you've raised $1 million one time, and you're going to get the benefit of it as you roll through the deals. And so, on our, going out and seeking them ourselves, obviously we utilize a tick structure the way that we do that, not to get too overly complicated, but, they invest alongside us as direct ownership into the deal. And so for us, being able to recycle the dollars, which we believe is a big deal to be able to do, it's going to be something that allows us to continue to purchase bigger deals and better locations and to continue this out for a long period of time.
That's
It's
great.
part of our long-term strategy.
I love that. I mean, it's obviously well thought out. You mentioned the tick structure, right? And these are obviously things that if you are an investor and you're wanting to know more about these things, obviously talking with, an attorney to structure these things the right way and ensure that you're protecting yourself and you're clearly, portraying that to your investor base. Now, shifting a little bit more to like current day and just all of the crazy variables that are, on the table for real estate investors to have to navigate right now. How are higher interest rates changing the way you guys look at deals right now? How are you thinking about interest rates? Obviously, Powell just had his last FOMC speech. He was a little more hawkish than people thought he was going to be. We've got the tariff conversation still around, maybe inflation, pushing up a little bit. Now you've got the Iran, we'll call it operation. Hopefully it doesn't turn into a long-term war that, is impacting energy and oil, which could impact rates. Like, how are you guys sorting through all the noise in the interest rate world and how it's impacting your business model?
Yeah, I mean, I like the word you just used, this noise. I get the benefit of still sitting on the board of a bank. And so a lot of guys will say it's our cheat code because we, every now and then we get to talk to the Fed and the treasuries and have a little understanding of what they're thinking and what's going on. And, but what I will tell you is, like on our last deal, I mean, we were very fortunate. The deal that we closed this month, we rate locked the day before the Iran conflict.
Ooh, good timing there.
Well, we were very fortunate, like very, very fortunate. That was a 12-month low at that point. And it's 40 plus basis points difference right now. I mean, that'd literally be the difference between, man, we did great to, man, we have a retrade. But what I will tell you is you have to adjust your models. And it's one of those things that's really unique. So like, I haven't looked at it in the last few hours, but the treasuries were up about 10 bips just today. Right? That's a pretty massive swing, and that's model changing. Like you'd have to sit there and go, I'm now going to have to change my model for today because of what's happened today. But guess what? It could be down 10 dips tomorrow.
Right.
Right. And so,
especially with the Trump's tweets, right? Depending on what he's tweeting out
right?
today.
And that's the thing. I mean, as much as we're not really a SOFR borrower or short-term rates that the Fed really controls. I mean, so when you hear about rates going down or going up in the market, it's typically at the Fed level. So it's going to be either Wall Street Journal Prime or, it's really the Fed rate or SOFR rate. We're more of a long-term borrower on agencies. So we play more in the treasury world, which those adjust up and down every single day.
Mm-hmm.
And so what I would tell you is you have to keep going. Sellers know too. So when the rates are going up, they recognize that it's more expensive for you to go get your capital to acquire the deal. And so whether they want to or not, most of them wouldn't, but there's going to be a price adjustment associated with that. And so, for us we're in acquisition mode too. So we absolutely are looking to buy. I wouldn't tell you we wouldn't be looking to sell right now just because it's a tougher market to do that in.
Yeah.
Buyers can be a little, pickier and choosier, and because of that, they can get better value. And so hence that's why we're buyers.
Yeah. Which kind of led into, my question around, you think we are in a buyer's market or entering a buyer's market? What's your perspective around that?
We've been in a buyer's market. I actually, honestly, from a multifamily real estate perspective, I think it'll come out years from now that the low was probably in 24. I think we've been steadily increasing since that time frame. And so I think the bottom of the market probably was in 2024. It looks like it's steadily increasing at this point, but it's not a shoot up since that time frame. It's been more of that slowly gradual. And so,
Yeah.
uh, yeah, I think from what I've seen so far, that's what it looks like. But that's really a time will tell thing. I'm giving a talk a little bit later on tonight and to a whole bunch of passive investors. And one of the things I'm going to tell them is specifically about interest rates and cap rates. If there are sponsors out there that say they know what interest rates are going to do, or they know what cap rates are going to do, that's probably not a sponsor I'd want to invest with, to be very frank, just because if that's the case, if I knew what interest rates are going to be due, we'd have this conversation on my own island somewhere, right?
Yeah. If you find the crystal ball that gives us that clarity, you let me know.
Yeah. But, sponsors do have the ability to control a few things. Like they can control their basis in a deal, right?
Yep.
What they're paying for. They can control the risks that they're taking. They can control the debt. They can control the execution of their business plan and things of that nature, right? So that, that's really where they should focus a lot of their sales pitch, so to speak, the things that they can control. And when you're talking about speculating on interest rates and, other things of that nature, I wish I could say, hey, this is what, and I'm fairly well-informed guy too. And I still have pretty good ends with, the people that have a lot of understanding of that. But what I would tell you is there's more and more data coming in every day that, can change the direction of the interest rate world. Or we can, like you said, this Iran conflict can end tomorrow and that'll change what's going on with treasuries, right?
Big time.
Or it can escalate more and that'll change what's going on with treasuries. And so, but if you look over the course of history, you look back the last 50 years, this stuff has always been going on.
Yeah. Yeah.
There's
it was
always
funny.
been these types of things going on.
I was talking with a buddy on a show earlier this week. We do kind of like a weekly segment. We were talking about, obviously the volatility and everything that's going on with this Iran conflict. And he was like, well, we had a bigger pullback in the stock market in April of last year than we did right now. And I was like, what happened last April? And he was like, exactly. Right? Like exactly. You can't even recite. I had to like Google and it was tariffs and China conflict and us going back and forth with them and, a bunch of, and there's always noise and narrative. I think that's part of what, the markets are orchestrated and engineered to do, right? Is to head fake you one way and they're doing something the other way at the same time. And so, but you got to, if you're playing the long game, and you got the crock pot mindset versus kind of the microwave mentality, you got to bet that, optimistically, as long as you don't get wiped out, you're going to probably be doing much better in the future than you are today. Right. And so,
and that's why I said about the 65% LTV on the debt, because to me, that's
kind of the sweet spot, right? If like
really helps, because if you sit there and you go, all right, we got to where we wanted to own it and things just aren't the way we want it to be, there's probably still a good chance that, you can refinance this because of where you were started with it and keep kicking that can down the road. And so in real estate, it's one of those things. I mean, you rarely, if ever, lose in real estate unless you run out of money or you run out of time.
Yeah.
Those are the two things you just can't run out of it. So if you run out of money, you're going to be hurt. If you run out of time, you'll be hurting. And so as long as you have those two things, you're still in the game.
Yeah, 100%. That's why I always say just be very optimistically cautious in your modeling and bake in more buffers and safety nets than, aggressive, hurdles and milestones that you think are going to be easy to hit. So as we wrap up, Sam, what is kind of your short-term outlook and maybe macro, outlook on the economy, state of commercial real estate as a whole? Like what's kind of if you had somebody putting a gun to your head and saying, give us your crystal ball, what's kind of your perspective specifically?
Yeah, I mean, I give you more for Texas. That's just because I'm better educated for that and probably less educated for the country. But, for Texas, I still think we have some things we're going to have to work out through in 26. I think there'll be selective good buying opportunities. And I do see rent growth coming back in a somewhat substantial way. And when I say that's somewhat substantial, I mean, most of the models in the past would put in a 3% rent growth. And I think there's definitely going to be some markets that will outstrip that. But, I can see the market overall down here probably getting back to that sometime next year even. And that's more a function of supply.
Yeah.
The demand is gonna continue to outstrip the supply, and so you're going to start to see you just have natural organic rent growth when that occurs, and so as occupancies rise, so do the rents, and so. But from a larger macro level with rates or things like that, I really try not to speculate too much on those, just because, I mean, as educated as I may be in that banking world and understanding the finance world, I can tell you that nobody really knows right now. And so, I know what the markets are telling us, but I also know what, a lot of the talking heads are telling us. And I do see, for us in Texas, we still have great job growth. We still have great population. I mean, Texas has more people moving to it. In the last year, there were 400,000 more people that moved here from one of the metrics I just read, which was twice as much as Florida, which was, the next highest state in the country. And 400,000 people was more than some entire regions of the country. And so, with foreign migration slowing down, it's definitely slowed down, but we still have a lot of in-migration, meaning people moving from California to Texas. And when you have jobs, which is really where we're still growing, you will have people moving there for them. And when you have people moving there for them, they'll have a need for four walls and a roof. And so, being a provider of housing is going to be something that is required by the growth the state keeps providing. And so, as long as we can keep, that growth going, it's going to be something it's a very healthy environment to invest in.
Well, I appreciate your insight and expertise on the show today. For those that want to know a little bit more about what you guys got going on, investment opportunities, what's the best place for them to connect with you at?
Yeah, it's through our website. It's real simple. It's lscre.com. If you just head there, you can get connected. We have all kinds of podcasts and books and underwriting models and things like that you can all download. And if you want to reach out to me directly, it's sam@lscre.com. That's my email. And I love hearing about new deals, new things that are going on, and potential partners.
Awesome. Thanks for joining the show, Sam.
Thanks, Matt.
Well, that wraps up today's episode. Thank you so much for tuning in. As always, you guys know this show would not be what it is without you, the amazing listener, the support, sharing this out with other people who can gain value from it, taking 60 seconds to leave a review. If you haven't done so already, those things mean the world to us and ultimately help us spread this message out to as many people as we possibly can to help them on their wealth building journey. If you have any particular links or resources that you're trying to track down that were mentioned in this interview, be sure to check out this episode at millionairemindcast.com, where you can find access to all that information. And of course, if you haven't checked out the Wise Investor Vault yet, be sure to head over to wiseinvestorvault.com to check out all the tools, all the resources, the checklists, the spreadsheets, the trackers, all kinds of amazing things that can help you on your wealth building journey at the wiseinvestorvault.com. If you haven't connected with me on social media yet, I'm consistently putting out more content, stories, value to help you on your wealth building journey. And one of the best and most exciting things for me on a weekly basis is getting to connect with you guys. Getting your DMs, hearing what things impacted you, what you need help with is a big way that we continue to drive the content for this show. So if we're not connected and following each other on Instagram, on social media at official Matty A, give me a like and a follow. Would love to connect with you there. And of course, don't forget to get on my deals list. If you're an accredited investor, you want to look at more deal flow. You want to see what deals I have access to, what deals I'm raising capital for. This is an exclusive list that I only put out to my accredited investor list, my Millionaire Mindcast family. So text the word deals to 844-447-1555. And with that being said, thank you again so much for supporting the show. Until next week's episode, keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers.